Welcome to the REI Diamond Interview, your source for real estate investment jewels of wisdom with Dan Breslin.
Welcome to the REI Diamonds Podcast, your source for real estate investment jewels of wisdom. I am Dan Breslin, and on these REI Diamonds podcasts, I have the chance to interview some of the real estate investment community's brightest minds. And today I'm here with a special guest who years ago helped me get started in the business and had given generously of his time and knowledge to kind of help me get started when I was a guy with no money, no deals, no experience, and never been to the settlement table, not even for my own property. Since that point in time, our guest today has kind of migrated into a different business, into the note business. He's now the founder and CEO or president, I guess, of PPR Note Company. And today's guest is Dave Van Horn. So, Dave, welcome to the show.
Hey, Dan, thanks for having me.
Nice. So why don't we talk about, kind of how you got into real estate and then how you migrated or evolved, rather, into the note business.
Well, how I got into real estate goes way back. I got out of college, couldn't get a job, was working construction, moved home to my mother's, and my mom said, why don't you try real estate? So I owe my mom for that. I went and got licensed and eventually started buying houses with credit cards and fixing them up with a credit card and moved a tenant in, refinance the property and pay the credit cards off, and started accumulating properties and actually got up to about 40 units. I owned 30 properties at one point. And then I, started, I was a realtor at a RE/MAX. I did property management. I was a partner in a title company. So I did a lot of different things over the years. Have even sold insurance and traded options and did all kinds of things. But real estate's always been my sweet spot. I still own. I own about 19 places right now. But I own thousands of loans, and I have a couple private note companies as well. And obviously, I'm president of PPR, and we have right around 25 employees right now. So pretty active, pretty good-sized business right now, and enjoying life. And the note business is kind of just another way to invest in real estate. A lot of times, it's another way to get the deal. And one of the things I tell people, Dan, is that, especially like newer people, I'm like, hey, we're all in the note business, right? Everybody has a credit card, a student loan, an auto loan, a mortgage on their property. We're all in the debt business. We're in the business of writing a check to the bank. And I'm just trying to get people to basically cross the aisle into, hey, what would it be like to receive the check? And for me, it started out when I was, I went to my local REIA group years ago looking for money to do more real estate deals. And what I found was the hard money business and the private money business. And that's where I started at first. I was putting lines of credit on my apartment buildings and my properties and using my IRA account. And then I realized, when people were lending me money, I was like, hey, I can do this. I can lend other people my money. And that's kind of how it started for me in the note business, doing first mortgage rehab, commercial rehab loans for other investors. And then it just morphed into, institutional notes like we do today. We're buying from major banks today, but we're buying pools of mortgages that are delinquent at a discount. And, we have asset managers that, modify loans and liquidate properties like REOs properties. And, sometimes it's just another way to get to a property is through the note. So I don't know if that's a segue, Dan, to the next question or what. So I said a lot there. So.
Yeah, it's an interesting path there. So we're talking about buying packages and pools of mortgages against properties that are delinquent. Right, Dave?
That's predominantly what we do today. So we only buy, my company, PPR only buys first and second liens mostly that are secured and 1 to 4 family residential. So that's our sweet spot. Occasionally we have some unsecured debt, but we don't buy commercial debt. We don't buy, credit card debt or student loan debt. Not yet anyway. We buy secured debt. I like that space. I like the fact that, if you think about it, it's anytime I can buy something, think about what I'm doing. I'm buying a mortgage at a discount with a high yield with collateral. So, and on top of that collateral, is it's 1 to 4 family residential. And if you think about Maslow's hierarchy of needs, right, everybody needs a place to live. So people have a vested interest into, figuring something out or that type of thing. So it's a unique space to be in. And when you're in the note business, you kind of, years ago I did a little bit of the We Buy Houses business. And if you think about it in the note business, you jump ahead of everybody. You're ahead of the We Buy Houses guy. You're ahead of the courthouse list. You're ahead of the sheriff's sale. In fact, my worst deal is when we're liquidating an REO. When we get the property back is my worst deal. And for most real estate investors, that's their deal, right? They want to get the property. For me, that's my worst deal. And when you go to a sheriff's sale, for example, you might be going, well, the attorney for the bank is who I'm bidding against. Well, that's my attorney. So you can see I'm across the aisle. Just a little bit different perspective here.
So let's dive into that a bit. We're talking first, second mortgages, both?
Yes. Well, we actually started out in the second lien space, and a lot of people are like, why would you do that? That's crazy. It's riskier. It was just by accident. It just happened to be the person, the note seller that was selling me product was in that space and kind of introduced me to that space and taught me a little bit about that space. That's all it had to do with. It had nothing to do with logic. It wasn't like I was thinking about that at the time. It's just what was someone willing to show me at first. And then later on, we morphed into the first lien space as we grew, largely because it's a bigger space with more product availability and more consistency of deal flow with the first lien space sometimes. But, we still have a lot of product, though. There's no problem with that right now.
All right, so we're buying first, we're buying seconds. I have a question pertaining to that, but I also want to step back a second. You said that your worst deal was the REO, so I assume, as our listeners probably are, you bought a first mortgage, or maybe you bought a second mortgage, and somehow you went through the process. Your attorney shows up at the sale, and you take the property back, and it's an REO now. Can you kind of fill us in on why that would be your worst deal? And then on the flip side, give us a...
I can't say it's always our worst deal, but it's where you're taking on more risk sometimes than if you modified the loan with the borrower is all I'm saying. If you modify the loan with the borrower, it always comes out a lot more favorably. It's more, usually there's a more positive outcome and it's more predictable. With the REO, you might have a case where the taxes could be higher than the property's worth or something like that, back taxes. Or the condition was just, so bad you couldn't get rid of it. But then again, we have a lot of those deals turn out to be good deals too. So a lot of it depends on how creative you are on liquidating the REO. For us, it's a time thing, and you got to realize we have assets all over the country. So we're in all 50 states. So, and we typically own around 100 REOs at any given time. So think about owning 100 properties all over the country. Most guys have trouble owning 100 properties right down the street, right? So think about how to manage that is a different animal. That's all I'm saying. But no, we still capitalize on a lot of that. And some of the ways we do that, for example, is sure we can sell the note, we can foreclose, and a lot of times we'll do private money for a rehabber because we own the property, or we'll originate a loan for an end buyer, or we'll do a lease option, right? We'll rent the property to someone for 5 years, 10 years, 30 years for that matter, and then sometimes we'll even deed the property to them for $1. So we never even create a mortgage. We just do a lease. We might say, Dan, you can rent it for 10 years. The rent will never go up. Your payment's less than market rent. And at the end, give us $1. The property's yours. Nice. So that's a sweet deal for people. So we can do all kinds of creative things on the exit just like anyone else. But those creative things take time. To the smaller investor, it's great because they have more time than we do. We're trying to liquidate volume, so it's harder. And that's what I mean by that.
That makes sense. So you're talking about modifying a loan and taking back REOs. I can only assume that we're talking about buying pools of mortgages that are bad debt, correct, Dave?
Yes. And that's predominantly what we do today. So we don't really originate. We buy existing debt, and then we modify we modify a good portion of that debt. We sell off some of the debt to other investors. A lot of times we get loans reperforming, and we sell them to real estate investors who like the idea of passive income without having to deal with tenants and maintenance and townships and things like that.
Let's talk about that a little bit. So you got, the small mom and pop real estate investors, if we want to call them that, who have some cash like me. And how do I participate? You're buying hundreds of loans. I mean, can you walk through breaking that down to, the simple single loan path as it goes through PPR, Dave?
Sure. I mean, from an investor point of view, I mean, we really have our main client is the investor, right? And we have different levels of that, right? So obviously we have, the investor that's a high net worth person. Well, a lot of times they'll invest in one of our funds and they get a nice high yield from the fund, and it's very passive. It's typically a 3-year term, and they just get payments ACH'd on the first of the month, right? And then we have investors who actually buy loans. And some of those fund investors do that as well. They'll buy loans, but anybody can buy a loan. You don't have to be an accredited investor or a high net worth person to buy a loan. And what's nice about buying a loan, especially like a reperforming loan, it's already in place with a servicer, which is like property management for a note, so to speak. So they do all the collections, all the statements, all the accounting. And managing notes is very easy, right? So, I own, plenty of notes privately. And like my wife, she never, like she'll say to me about my properties, like, don't you die and leave me all that junk. But she'll never say that about my notes, because she'll see the payments just coming in like clockwork. There's no maintenance. There's no phone call. There's no property. You know what I mean? It's just a different dynamic. And notes are very liquid. They're a lot more liquid than real estate. I can sell a note in about 15 minutes. I don't know if I can sell a piece of real estate in 15 minutes. You probably can on eBay, but you know what I mean. It's definitely more liquid with paper. You can borrow against the note. You can sell a partial of the note. So it's definitely more liquid than real estate. So, we sell thousands of loans, so it's very liquid compared to selling an actual piece of property.
And it's probably an easy statement for the president of PPR Note Company to make. Let's talk about somebody who's trying to sell a note, a one-off deal. What if I was trying to sell a note back into the market because I invest $20,000 for the return and then I want to turn around and sell it? Am I going to have to give it away at 65 cents on the dollar, Dave? Or is it the kind of thing, if I made the investment, would I be able to come back to a company like you who bought the note and you would be able to kind of complete the transaction and get me my cash back out?
We don't typically buy. I mean, we warranty the notes we sell that are reperforming. So if it was a redefault, we would buy that back from our note buyers. But as far as buying a one-off note deal, we don't normally do that because we're buying in volume from banks. But there are plenty of places to sell your note, whether it's like an auction.com, a loanmls.com type place. There's also, believe it or not, we sell a lot of notes on the note Facebook groups, the LinkedIn groups. Like we have a LinkedIn group, Distressed Second Mortgages group on LinkedIn. People sell notes on there all day long. Now you can also go to exchanges. So like we use FCI for servicing, and they have an exchange. You can sell your note right on their exchange. So it's a lot easier than people think. They're just not aware of it. That's all.
All right.
Yeah.
So suppose you have somebody who's kind of brand new to the note business. I mean, where should somebody start to figure this out?
Well, it depends on what type of investor they are and how active they want to be. But it's really like anything. You want to get a little bit educated in the space. You might want to hang out with some people doing the note business. And then maybe, there's plenty of note coaches out there as well. So it's really what level do you want to – it's just like investing in real estate, right? Do you want to hang out with other people doing it? Do you want to learn more about what you're doing? The thing with the note business is it's just like real estate. There's a million ways to make money. So it's really what area do you want to dive into and learn more about. We do some education as well. We write about notes a lot on Bigger Pockets, places like that. We have some forum groups as well. Like I said, mentioned the LinkedIn group we have. We answer questions on places like our LinkedIn group or Bigger Pockets, that type of thing. And then we even, we have people that call in and take some of our stuff. We have some online courses as well. So it's, there's plenty of information out there about notes. It's just there's not as many people doing it. It's a smaller group. And, like real estate investors is a huge, group of people, whereas note investing is a smaller group. It would be like, hard money lenders, right? That's a smaller group of real estate investors, right? But when you really think about a hard money lender, he's doing first mortgages. A hard money lender's in the note business. The typical hard money lender that I know, Dan, and maybe correct me if I'm wrong, you know plenty of hard money lenders. Most of those hard money lenders already have a nice portfolio of real estate. A lot of them have gone out and gotten like a business line of credit against their real estate, and they start lending out private money to, hard money to other rehabbers, right? Well, why do they do that? Why don't they go buy another 100 houses? Well, it's easier to do the hard money, right? I mean, it's just like, so it starts to become more scalable. Well, my business is just a little bit more scalable than the hard money guys, because the hard money, he can only deploy so much money locally, and he's got to go find the next deal because they're short term. Mine, I can deploy a lot more capital because it's all over the country for longer term periods. So I can get similar yields to that for a longer period of time with more capital. That's the only difference between me and, you know, maybe a hard money fund or hard money capital. Does that make any sense? Whereas a smaller, you know, so a small guy, he's got a little bit of money to deploy. The hard money guy, he's got more money. But he's got, after a while, the hard money becomes a job locally because he's got to go around and find more hard money deals, lend more money out, you know, inspect more properties, that kind of thing. But so I have a little bit less of that. Yeah, I'm just trying to give you some perspective. But when you really think about it, the hard money guy is in the note business. That's my point. You know.
So you mentioned that both the hard money guys and the note investors are smaller groups. Is that, Dave, because there's just larger capital requirements, or could somebody with a minimal amount of capital somehow break into the note business the same way they can in the real estate business?
It's both. I mean, we built our whole company with other people's money. So very little of our capital built my company. So most of the capital that built my company was private equity. As far as, so I'm just leveraging capital just like a small guy would. I'm just doing it on a higher level. But and if you think about the hard money guy, he's leveraging the bank's money. That's all he's doing in most cases. So we're all leveraging money. Now, the small investor just thinks small, right? He's leveraging his own money.
Mm-hmm.
And the hard money guy, he's leveraging his business line of credit backed by the equity in all his properties, right? That's what he's typically doing. Me, I'm using private equity and leveraging that equity to build my business and build my company and build my note portfolio, you know. So it's just a different level of leverage if you think about it.
So along the way, somewhere in your career, you became very comfortable with the private equity. Can you talk about maybe, you know, raising money from other people and some of the pitfalls or things that on either side, from the borrower and even from somebody who's lending private money? I mean, what are some of the things some lessons you've learned along the way there, Dave?
Well, it's really as simple as reputation and track record. So in the beginning, you'll see guys lending money for one deal or borrowing money for one of their projects, right? It's really do what you say you're going to do. Pay people back on time, do the right thing. It's really, you know, it's just do what you say you're going to do, right? Be moral about it. Then the next side is you gradually work your way up, right? So for me, I started raising capital for commercial real estate, you know, whether it was mobile home parks and storage centers, and we were doing commercial office condos. So then when it came to raising money for notes, it was just a normal transition. I was already used to raising private equity. But it's really about your track record. Do you do what you say you're going to do? Are you a trustworthy person? Do people have confidence and comfort with you? It's just like anything else, really. You know, why would people give me capital today? Well, the reason is because we've been doing this since 2007. You know, you got an 8-year track record of good performance. So why wouldn't people give you money? I don't know that too many things can say that, right? So that's part of it. But yeah, I mean, it's really a function of doing what you say you're going to do and being professional and that type of thing.
It's interesting to note that it was through 2007, 8, 9, 10 that you were building the solid returns for other investors in a time where a lot of people were scared and, you know, losing on their investments. That's a commendable deed right there, Dave.
Well, it kind of was feast or famine for us at the time. My one partner was a loan officer and I was a realtor. It was feast or famine, and I literally went from selling about 75 properties a year to about 7 properties a year. So if I didn't get on the other side of the fence and say, which side of this downturn do we want to be on, I would have been just another starving, struggling realtor at the time if I didn't change gears. But we were around a while. You've known me a long time. We kind of saw it coming. We knew the market was going to tank. We knew it was going to tank for a long period of time. And we just found that the distressed debt space, we actually got into it probably about 3 years prior to that, around 2004, 2005. was first introduced to it, distressed debt in volume, and just dabbled in it. My partner did a little bit. I didn't really do much. I just sat back and watched. But when the opportunity came, it's just like any opportunity, right? You got to be willing to accept it when it comes by. It's like Joel Osteen says, "Are you ready to receive it today?" If you're not ready to receive it, that opportunity just keeps going, right? So it's kind of like that. And I was just in the right place at the right time. It was purely accident, but I took action when it came by,
Makes sense. I'm familiar, and I think a lot of people listening are probably familiar with the formula, the discount that's needed for, the We Buy Houses business, 65 cents on the dollar. We're going to minus the repairs. We're going to do the repairs, fix it up. Can we talk about two things, Dave? One, the discounts that somebody is going to expect or maybe should be in the ballpark there. I know I can't hold you to an exact figure because it's a market rate, but the discount of performing first mortgage would bring. So if somebody wanted to invest $100,000, buy a note that was worth X amount more, and what kind of return on that versus, a non-performing or distressed first mortgage. And then we could also kind of look at it for second mortgages as well, because I think there would probably be different discount rates on any of those assets, right, Dave? You follow me?
Yes. So you're saying a lot.
I am.
Part of the reason that it's not a real simple thing, and people go, "Why are you dodging what I'm asking you?" It's because there's multiple categories of both of those asset classes. So in other words, first mortgages, for example, the larger the balance at origination, the more they sell for. So I'll give you an example. First mortgages that are over $250,000 at origination, they sell at a premium. They could be 65, 70 cents all day long. And you might go, "Well, that's crazy. Why is it so high?" And it's because there's so many large hedge funds that have cheap capital, whether it's insurance company money, pension fund money. They have very cheap capital and a lot of it. And they don't need to make a high yield on it. And the reason they like those big balance first is because the collateral behind them tends to be better. Does that make any sense?
I follow that.
I specialize more in low balance first liens. So our typical first liens are under 150 grand at origination, definitely under 100 grand at origination is probably where the bulk of what we buy is. And as you get lower and lower and lower, they get cheaper. So, as you get to, 50 grand, you might buy stuff at 50 or 60 cents on the dollar. You get down lower, you get down to $20,000, you might, I'm trying to think of the cheapest first we've ever bought. It's probably 12 cents, 20 cents. You know what I mean? So it gets cheaper and cheaper and cheaper, and it's because the risk goes up. But it's a space that we like and we know how to navigate it. It's just like managing risk. As you learn to manage the risk, you become more comfortable with it. With first liens, though, you're exiting through the property in most cases, and it's a sticks and bricks business. With second liens, it's more statistical, and you're exiting through the borrower more than the property. So it's a different animal. And just to give you a perspective on second liens, there's probably 18 categories that come to mind of second liens to me, because you have stuff that's 30 days late, 60 days late, 90 days late, 120 days late, 150 plus days late on the senior lien. And then you have equity, partial equity, and no equity. So do that combination. You got about 18 categories in note. And you'll see them trade from the worst category, which is where they're delinquent 150 plus days on their first mortgage and they're delinquent on the second. Well, that might trade at 3 cents, say. And then you'll see the other extreme that might trade at 30 or 40 cents on the dollar, where there's a lot of equity in the deal. So a lot of people, so I'll give you those extremes. If you have a $50,000 first and a $50,000 second and the property's worth 300 grand, is that second mortgage risky? And the answer is no. It's almost like a first, right? And then you go to the other extreme. Well, it's delinquent on the first for 150 plus days and it's delinquent on the second. Why would anybody buy that asset, right? You might say to yourself. But there's still money to be made on some of those asset classes, even the worst case. And the way they make money is, I'll give you a couple examples. One could be short sales. They could get paid $2,500 to $8,500 just to sign off on a short sale. Well, I've bought loans in that category in Detroit for $80. So would I take $2,500 to sign off? Sure.
Nice.
Why wouldn't I? Right? So you got to put it in perspective, because people might go, "Well, that's a risky category. I'd never buy that category." But what if I told you I bought a loan for $80? You might go, well, $80 ain't that much. That's not that much risk. Exactly. You know what I mean? So put it in perspective. Did you spend $80,000 for the loan, or did you spend $80? Now, the other side of that coin is you might have a loan that's reporting a false negative to credit, so you can't tell that they're doing a loan mod with the first mortgage. So you might have a person that's paying on their first mortgage after they did a loan mod on the first, and you have no way of knowing that, and it's reporting negative to credit, and you bought that 3-cent loan. You know, you bought a $100,000 loan for $3,000. But then you found out, no, they were paying their first. Well, that's like a good second lien at that point, right? You have a 7 or 8 out of 10 chance of getting that worked out. Well, that could be a home run for you. That's another way. And a third way would be just renting that property out, foreclosing, renting it out, rent it out subject to the first, rent it out till the first forecloses. You could also rent it out and pay the first and keep it, So especially if rent was higher than the mortgage payment on the first and you own the second and foreclosed. So I'm saying a lot here, Dan, but there's a lot you can do,
Yeah, I got a ton of notes. I mean, I was writing a mile a minute there as you touched on some great information there, Dave. How many of those high risk, one extreme loans? I mean, we're talking, I can't buy that for $80. You're obviously having to take that in with the package, or maybe I'm buying it from you for a few $100, something like that. Am I correct in that assumption, Dave?
Well, no, I'll give you an example. I had a buddy that when he started in the business, he bought 10 loans from us for $10,000, which is ridiculously cheap, right? And they were in the worst category, right? But he cashed out a one for $39,000. Well, there you go. That's all it took was one. Now, you might only make money on 2 or 3 out of 10 in that category. So if you only bought 1 or 2 and you lost your money, you'd be like, oh, this business sucks, but it's not really the case all the time, So it's your biggest risk in the note business that I tell people is not the note business. It's you. You're the biggest risk because you don't have enough capital deployed and you don't have enough diversification, right? Like Bank of America doesn't worry about a deed of trust state. Bank of America doesn't worry about rural or urban or anything, right? They have so much capital deployed in all 50 states, they don't worry about it, right? The reason we have more risk is because we have fewer loans. If you think about it, the banks have had the same default rate forever, In a normal market, it's a 1 to 2% default rate. In a bad market, it goes up a little. So 90-something% of the time, they never have an issue. But your risk is you bought one of the loans that was in the default part and you didn't have enough exposure. You know what I mean?
Yeah, that makes sense.
So, and a lot of people are always trying to look for the perfect note. Well, I don't know how you find that because there's, 4 main reasons people default, which is death, divorce, job loss, and medical. Well, I don't have the crystal ball to predict that. So anybody that's teaching you about buying the perfect note, I'm not saying don't do due diligence and don't underwrite a loan. I'm just saying, how does anyone know that?
Here's what it sounds like to me, Dave. You got 2 mindsets, and I'm probably of the first mindset as, the large group of real estate investors are. And I'd say the first mindset is like the first mortgages. We are familiar with picking the perfect property and waiting on the sideline, making 100 offers and looking at 100 houses before we pick the one deal where we deploy our capital and we exit through the property, like the first mortgages. So I think that mindset is that way. And then you're now talking about this other mindset, which, I mean, in a sense, I don't know that it correlates perfectly with exiting through the borrower, but it certainly is a deploy more capital and a mindset like to be able to fathom buying like 10 properties and then making it at such a discount that you made money on 2 or 3 and then you literally like lost money on the other 7, like you talked about.
You don't worry about it. Yeah.
Yeah, so it's like two different mindsets. One is more of a looking at the like the algorithm or the success rates and kind of almost a statistical analyzation as opposed to, analyzing the property one at a time, right?
You're absolutely right. You're going to win more than you lose. In fact, I've had properties, like we just have one in like an urban place in Tennessee. We sold it for less than we paid for it. But it's in the group that we don't care because 8 or 9 out of 10 of the notes we've done really well on, and, okay, 10 or 20% you're not going to do very well on. You don't care. You don't even care if you get your money back. It's like you don't care because that's not where your money was. That's not where your revenue bucket was. Do you know what I mean?
This is an important shift in mindset right here. This is, where I am personally. For me to make that transition, Dave, would you be able to help me out with like a dollar amount that I should come to the table with if I expected to get in and be able to lose a few bucks? But, am I talking I could get in the game at 10,000, like the example you gave us, or should I be somebody who's prepared to bring $50, $100, or $200,000 to the table if I was going to invest, in some of this non-performing stuff before we shift to the performing side?
They're totally different animals, right? So a lot of times when people are new, there's a couple ways that make sense to start out, right? So, like a fund investor, our minimum is only $10,000, although our average fund investor is $200,000 to $300,000, depending whether it's a first or second lien fund. So you can see there are larger investors, even though the minimum is low. When it comes to buying a note, most notes that we sell are probably between $10,000 and $60,000, and that's on the performing side. On the non-performing side, it's all over the place where they could be. They're usually about, this is very general, probably a third of what a performer would sell at. So they're different things. It's just like when you buy a house that you're going to rehab, right? You buy the shell, you're going to rehab it. Obviously, you're getting it cheaper than the retail guy who buys a duplex retail, right? It's a different animal. It's not the same thing. It's not fair to compare them. Well, it's the same way with notes. It's really how active are you going to be and how passive are you, and then how much knowledge do you have. Obviously, it takes a lot more knowledge and a lot more activity to work non-performing notes. And in reality, it's not even the real estate knowledge or lending knowledge. It's really collections. So you got to know a lot of different things that, not everybody's cut out for that, right? So it's a different job skill. Our best asset managers are not real estate people. They're not lenders. In fact, some of them were, teachers, car salesmen, things like that. So it's a different position, really. So just keep that in mind, But to your point, it's kind of like, now if you wanted to get started in non-performing, it's probably better to, shadow someone else's deal or buy a practice note. That's what, we used to do that. We used to, new people would start out with a cheap note, or they'd start out with a safe note and just run with that till they learn the business and learn the processes, that kind of thing.
On the second mortgages, and you're buying bad debt, you mentioned that you were exiting through the borrower. Is that the skill of collections you just mentioned, Dave? Yes.
It's more of well, sometimes you got to look at it this way, too. Sometimes, even though people perceive second mortgages as more risky, a lot of times the borrower on a delinquent first is more banged up than the borrower on a delinquent second that's paying their first. Does that make sense?
Yes, sir.
Financially, more banged up financially.
Do you have a couple examples, or maybe just one example you could share about exiting through the borrower and kind of a little bit of how that worked out on a specific second mortgage that you're saying might be less banged up than the first?
Well, there's a lot of things that happen. So a lot of times when we're calling a delinquent second mortgage person, it would be more like, hey, what happened? Where are you at now? What would you like to do? Let me help you do that. And a lot of times legal's moving forward. And what happens is, a lot of times they'll go through different scenarios of telling stories of other families we've helped. So they might say, hey, I had a family in Oregon. We helped them. They were able to access their 401k while they were in foreclosure penalty-free. Is that something that and they might go, well, I don't have a 401k. But we, believe it or not, we have people that do that and cash us out. We do a discounted payoff for them. So that might be a case where, we bought the loan for $10,000. They owe $30,000 and they gave us $20,000 and we made the 30 go away, that kind of thing. And then there's, we have a friends and family program where we might have a case where we would sell the loan to Uncle Louie of the borrower, of the uncle of the borrower, where we'd sell that loan to the uncle for $20,000 and he might lend his niece the money because he has a secured lien now. He might be more inclined to do that and we get cashed out of that deal. And then there's other deals where we would create a new payment plan where we'd lower the interest rate, lower the payment, maybe reduce principal, extend the term, and we rework the loan, and then we keep the loan as a performing loan, and we might be happy with that yield, Or we might sell that loan once it got a little seasoning under its belt. Hey Dan, you want to buy this loan? It pays $300 a month for the next 25 years or whatever. And you might say, hey, I'll give you 17 or 18 grand for that, Dave, being they owe 30 and you bought it for 10, and I'll pay 18 for that to get that $300 a month payment stream. And typically our performing notes have returns anywhere from, on first liens, they're right around 12%. With second liens, they're probably anywhere from 13 to 15% returns, depending on equity and things like that.
Sounds like a pretty big windfall. I mean, what if that person suddenly comes in the money or they sell the property? I mean, I guess there's a chance that some of these could cash out before they're mature, right? People sell property all the time, Dave.
The majority of them do. The average loan in the U.S. is 5 to 7 years. And even in a down market, even if it's longer, say it's 7 to 10 years, very few people keep a 30-year loan all the way out. You know, they refinance, they get divorced, they move, to your point. And we call that a kicker, the difference between what they owe and what you bought that loan for. So not only are you getting this, cash flow of monthly payments while you wait, you could get this potential kicker down the road. And if you do that in your IRA account, getting these, 12 to 15% returns with a kicker in your IRA, it's not a bad deal, right? So.
Yeah, I mean, that could create a problem for some investors. I mean, if somebody's got, a sizable chunk of change that they've invested in a pool of performing second notes, and then you almost have a problem. You get $12,000 taxable event, right? You bought it for 18. They sell the property, you get $29,000 in change back a couple years in. What could somebody do? Can you still do like a 1031 exchange and mitigate your tax liability on something like that, Dave?
Well, you can't do 1031s with notes, but you can definitely do IRA investing and that type of thing. Usually it's considered, with a note, it's considered interest income or a short-term or long-term capital gain, depending on how long you own the note. So if you own the note a year and a day, that's a difference. Now, you can also sell a partial of the note. So you could just say, hey, I paid, 10 grand for this note. I just want to get my 10 grand back. Well, you could just sell the first 5 or 10 years of payments or the first 10 grand of that note that's now worth 20 grand, say. Well, I could sell the first, 10 or 15 years of payments for that same amount. And now I got all my money back, and now I kept the back end of that note. Another thing you can do is you can borrow against the note. It's called a collateral assignment, a note and mortgage. It's where you put the note up as collateral for a loan. It's just like a car loan would be. You know how you put the car up for collateral on the car loan? Well, you're putting the performing mortgage up for a private loan with someone. So they give you your money back. Well, now it's non-taxable because it was a loan. That's actually how we built our business in the beginning. We were doing hundreds of collateral assignments. We had performing loans. We didn't really have people to buy them. A lot of people didn't even know what they were at the time, and we were doing collateral assignments. We were borrowing against our performing loans, and it was tax-free because it was a loan. And we literally built our company like that with tax-free money. So, and you can still cash flow off those collateral assignments. And what's nice about them is you protect the lender by doing a recording in the county courthouse where the property behind the note's located. So that's how you secure your investor. So it's a nice, it's just like a little bit extra step as to somebody giving you like a private money deal to do your real estate deal,
It's a little complex, Dave. We got, multiple notes in a portfolio. We're whacking them up, 5 years to this guy, 10 years to this guy. We're collateral signing back for. How is all this activity and all this payment being distributed and handled as far as management goes? For somebody who's small, say somebody's got $300,000 in IRA and they implemented this system and it took them a year to put this portfolio together. Now this thing's going, 50 different directions. Is there a company, a servicer, or do you guys handle some of that confusion?
No, absolutely. There's plenty of servicing companies out there. Currently we use FCI. They service our loans. They do all the collections. They'll do all the statements. They send all the late notices. They'll give you a portal. You can go view all your notes. You can see who paid, who didn't pay. They give you year-end reporting to you and the borrowers. I mean, it's very passive. I literally take 12-month statements, hand it to my accountant, I'm done. I can't do that with my properties, So it's different that way. It's actually much easier in that regard. The servicer does all the work. Now, they only charge $15 a month per file, which is much cheaper than property management when you think about it. You know what I mean? Like, so whether the loan payment's $300 a month or $3,000 a month, it's $15 a month. when I look at my property management bills, I have $1,000 a month rent, and I'm cash flowing $300 a month on a $100,000 property or whatever. Well, now I'm paying the property manager 8%. Well, that's $80 out of my $300 cash flow. I'll take $15 over my $300 cash flow any day. You know what I mean?
Yeah,
so it's a lot more
you're
scalable.
right about that.
Yeah, it's a lot more scalable, and it's a lot, it's more automated. And the cool part is about notes, like I could travel with my notes, right? I could put them all in a suitcase and go to Arizona. Well, I can't do that with my properties, right? I can't go to South America for a year and not worry about my properties. Even if I have a manager, I got to deal with them. Whereas with notes, you can do them from anywhere. It's all electronic and phone. It's a different animal that way, though, Dan.
Yeah, you're right about that. So what about from my perspective as a one-note buyer? I mean, what kind of due diligence would you do if you were in my shoes or one of our listeners' shoes who's going to buy their first note or, going to buy their seventh note? How would you, Dave Van Horn, analyze that deal?
Well, it depends on the type of note, but let's take a first mortgage, for example. It's pretty simple. I mean, really all you're checking is value, right? The equity behind the note. You're checking things like taxes and any liens. So you're doing an E&O report, an encumbrance and occupancy report. They're like, $100 or whatever. And you can say, well, what liens are against the property? And really all I need to know is what's the payoff, what's the UPB, the current balance on this note. And the back, once I know the value, what's owed on the note, what they're asking for, it's real simple equation. It's not rocket science. Doing first mortgages is about as simple as it comes. I mean, so it's, what are the liens and, just figure it out. It's easy. I mean, you do it every day as a real estate investor. Yeah, I mean.
Do you look at the borrower, though? I mean, are you looking at the person who's supposed to be paying the mortgage? Is that important?
What's to look at? They're delinquent. There's not much to look at. So, yeah, once in a while you'll hear that somebody will say, oh, I want to pull their credit. Well, on a first lien, it's irrelevant if it's delinquent. What's the point? You already know it's bad.
Okay, so that's for delinquent, yeah.
Yeah, so if you're looking at a delinquent second, you're pulling credit, but you're not pulling it for the credit score necessarily. You're pulling it more for the see what the senior lien's doing. That's what is it current? You're verifying that it is current. With a first lien, you might look at condition. You might look, is it in a floodplain? Is there a homeowner association? That kind of thing. But it's kind of normal due diligence you would do buying a property almost.
Okay, that makes sense. Because
think about it. If you're going to exit through the property, in a way, you're buying the property 7 out of 10 times or 6 out of 10. You know what I mean? So what's cool about that, you don't want to necessarily force the outcome. You want the outcome. It's almost like I don't want to force a homeowner into a workout agreement. I don't want to force a homeowner to exit the property. I just want the best outcome for everybody. So if somebody wants to stay there and rework the loan in a legitimate way, and that's great. If I got to exit through the property, that's great. No matter how as long as I'm happy with, no matter how I exit, and I'm happy with that return, then it's a good deal, right? So.
Yeah, I mean, it sounds like there's a lot more flexibility in the note business, and you have a myriad options is kind of the strategy of negotiating as opposed to, taking up positions. I mean, my positions, I'm going to offer $20,000 for the property. I could go up to 25, and the seller has to be willing to be flexible and on their position. And there's really only, one or two ways if you get into them holding the note on a piece of real estate, whereas it sounds like there's just a lot more flexibility in the note business.
Well, yeah, we call it like move in all directions at once till the favorable outcome appears, and it kind of doesn't matter what the outcome is because most of them are favorable most of the time, So it's like
makes sense.
Whereas a lot of the real estate guys, they only know one way to I want to exit this way, and sometimes you're shoving a round peg in a square hole or something.
So to keep it simple, could you sum up, note buying from our side of the table, not necessarily yours, in 3 to 5 steps, Dave?
Yeah, I mean, it's pretty easy. It's a unique way. It's just another tool in your tool belt to potentially get a property. It's another way to invest in an asset-backed investment, that's more passive, right? You don't have to deal with tenants, townships, that type of thing, but you can still cash flow from it. So it's a unique investment that way. Now, I'm not saying it's better than, I'm not saying notes are better than real estate or real estate's better than, stocks and bonds. Or I'm not saying that. I'm just saying they're different, right? They're a little bit different tax-wise. They're a little bit different investment-wise, but they're great investments, and they have great yields. And it's just another strategy, just another tool belt, a tool in your tool belt, when investing in real estate,
Nice. So I like to ask my listeners, have you read any good books that you could recommend lately, Dave?
Oh, geez. I read a lot. I literally read like 4 and 5 at a time.
Nice.
Probably lately, I've been reading Outliers by Gladwell. I just read, one of my favorites is Misfortune by Doug Andrews, and I like Killing Sacred Cows. Killing Sacred Cows is like getting rid of your old ways of thinking kind of thing. And one I read recently was Business Brilliant by Louis Schiff. And the reason I like Business Brilliant is Louis Schiff's from Inc. magazine, and I actually just saw him speak up at the Union League. And what was interesting about him is he's got one of the coolest jobs, for me anyway, he interviews billionaires all day. And there's a lot of data in that book of what do billionaires do, and he interviews all types of billionaires from all different income backgrounds. So he'll take a billionaire who came from nothing, and then he does all these surveys with them. And the data is really interesting of what these guys do with their things in their life, So it's an interesting read if you get a chance to pick up Business Brilliant. It's a great book on the truly successful, how they did it. And he's got guys in there that make $300 million a year and up, and what's their day look like, right? It's not like mine. But it's but it's an interesting read on their perspective of failure and doing things differently and thinking differently. If I ask a person who makes $0 to $50,000, how do you get your income? What would they say? They would say from their job, right? But if I ask a billionaire, where did you get all your income? They would say business equity. So it's just a different perspective of how they think, and what they do, So good read, good pickup, good book to pick up if you're aspiring to get to the next level.
Yeah, I appreciate that. Recommendations. It's always interesting. Picking the next right book to read has been instrumental in my own changes over the past few years, doubling my income again, doubling it again, and I can point to knowledge that I picked up from books and from, podcasts and interviews and talking with smart people like yourself, Dave, as the source of the mind matter that develops good ideas, which can be implemented to make money. So I love getting the perspective on that. It looks like, Dave, we're kind of getting to the top of the hour now, so I have one more question that I'd like you to answer 2 ways, if you could. First, for the investor that's just getting started, whether it's in real estate, whether it's in notes, and then also for kind of the seasoned pro who maybe already has 25, 35, 95 properties, since you've kind of made some shifts there. Do you have any final jewels of wisdom to share with our listeners?
Well, anytime you're venturing into anything new, I was a new note buyer, right? But you really had to, like you said, get a little educated in the space, network with some people that are doing the business, get a feel for, well, what are they doing? And, mirror some of their trades, mirror what they're buying. I have a young guy in my office who's trying to rehab a house. I said, well, there's 2 other guys in the office rehabbing houses. Go analyze the last deal they did. Go analyze the deal they're working on now, and bring them all to me, and we'll talk about them, before you even buy your first deal. Right? Because you want to hang out with people that are already doing it, right? You want to take advice from people that aren't doing it. So that's part of it. And if you can get a coach along the way, sometimes that'll accelerate your learning too. But the other thing is you got to be willing to take action, though. Some people will just sit in the sidelines and never do anything. And there are some easy ways to get started in the note business. Hey, maybe you do a private money deal for Dan, or maybe you do. You know how a lot of the young people in my office get into the note business, Dan? They start out with lendingclub.com. Lending Club costs $20 to get in the note business, right? And you can invest in Lending Club. You're in the note business. You're investing in pieces of unsecured notes. It's a $9 billion company. You can average 10% plus returns all day long in Lending Club. Guys in my office do it all the time. So there's great ways to get started with a nominal amount of money and start to learn the note business,
Interesting. What about seasoned pros, Dave?
Seasoned pros, some of them are, most real estate investors like myself, we're control freaks. So a lot of those guys might be happier buying the note. A lot of them want to hold it, touch it, feel it, drive by it, look in the windows. I did that for a short period of time in the note business, but after a while you realize how ridiculous that is. And today I own thousands of loans all over the country and hundreds of properties that I've never seen. So you start to realize how silly that is over time. I can send someone out to a property almost anywhere in the U.S. for about $40. I don't know if I can drive down the street and look at it myself for $40. So it's really what's your time worth and where you're really trying to go with this, But we have boots on the ground all over the country, so it's easier to do than people think, especially with all the technology today. It's really simple today.
Nice. I know the answer to this, but I'm sure that some of the people are wondering, how can we get more information about you and your company, Dave? I know you put a lot of stuff out there.
Well, yeah, we have a website, obviously, pprnoteco.com, pprnoteco.com. Or you can, we have an 800 number, 877-395-1290. If someone's interested in, funds or becoming a registered note buyer or just information on some educational stuff, we have all that type of stuff. So more than happy to help anyone, Dan.
Nice. Well, Dave, thank you for coming on the show. It's been wonderful. I've got 3-4 pages of notes here myself. I hope our listeners have done the same.
My pleasure, Dan. Thanks for having me.
Cool. And thank you for listening to this episode of the REI Diamonds Podcast, your source for real estate investment and jewels of wisdom. You can sign up to receive an email update of new weekly interviews at www.reidiamonds.com. You can also check out past interviews at that site. As a bonus for signing up, I'll even send you my free report titled 7 Sources of Off-Market Deals. That website again is www.reidiamonds.com. Until next time, this is Dan Breslin signing off.
Thanks for listening to the REI Diamond Interview. To receive the REI Diamonds newsletter and interview monthly, sign up now at www.reidiamonds.com.